Broker Studio in New York City, streaming live on YouTube and streaming live on Bloomberg.com. I think most economists are saying, the things you got to worry about with this hot war in the Middle East is you got potentially inflation and then potentially, and maybe even more so, a slowing economy. But if you can look past that, or if there is no recession, things look pretty good out there. If you think about the pre-Iran days, I think our next guest kind of shares that view. David Waddell, he's the CEO and Chief Investment Strategist at Waddell Associates, joining us here via Zoom. So, David, how are you kind of navigating the near-term uncertainty of this war versus maybe a little bit more optimistic outlook if you can look medium and longer term?
Well, I think people have over-indexed to the war, really. War is just an input, right? The things that matter are the economy and earnings and inflation. The economy looks pretty strong. In fact, if you look at the Citigroup earnings or economic surprise numbers, they're still positive. GDP now is positive. We actually have positive ISMs on manufacturing and services. We got a decent JOLTS number this morning. And so if the economy is going to be positive on the year, then the market has historically an 85% chance of rising. Then we look at earnings. I think coming into the year, energy earnings were supposed to be up 3 or 4%. Now they're supposed to be up 20%. You've seen a little bit of a downtick maybe in industrials expectations, but the rest of the earnings complex is pretty strong. In fact, earnings expectations for the quarter are 13%, 17% going into the end of the year, and those have been rising. The part where the war shows up is in the inflation expectations. Even before the war started, there was some trouble in semiconductor land. If that's the new oil, we are also seeing shortages there. Then, of course, you have what's going on in the energy complex. And so that probably presses the inflation up some, but that's not really the surprise. The risk coming into the year was higher inflation. So the way to play it was to favor things with lower PEs, higher cash flows. And if you did that, your portfolio is flat on the year and the S&P is down 7%. So overall, I think we moved through this. We went through, and I'll vamp on this for a second. I was thinking about Trump when he stood in the Rose Garden with his Chinese menu of tariffs, that added up to 28%. By the end of the year, we were at 12%. If you think about the war campaign, it started off with, well, we'll just eliminate the regime. Well, unfortunately, there are 18 million Iranians who support the regime. So you killed the top 10 or 20, you still got 18 million more. That's kind of a problem. So then we shifted to, all right, well, maybe it's about the Strait. But then we realized, oil's up 60%, the US stock market's down 6%. Really, all that oil goes to Asia and Europe. Maybe we're not as worried about the Strait. And now it seems like we pivoted to, well, we just need to disarm them. And if this is geopolitical hygiene, maybe this is something we do every few years. That's why the market's rallying today. So he's been de-escalating, which is why I think the rally today is probably appropriate.
Right, but as long as the Strait of Hormuz is not resolved, that will keep oil prices elevated. And at some point, that's going to, whether it shows up in inflation or not, it will definitely reduce demand through demand destruction and potentially slow down the economy. So how does that change the outlook for the U.S. economy?
I think it's important to just size what you said, right? I mean, we generate, it only takes 4% or so of inputs for GDP to come from energy. And our energy intensity numbers are way down. We're also a net exporter of energy. We also have 1% GDP stimulus coming from AI. We have 1% GDP stimulus, which haven't even hit yet, coming from the one big beautiful bill. So, if you look at the scales, I mean, obviously oil pushes the scales down, but we got a lot of other things pushing the scales up, and that's why the market hasn't gone down all that much. So you're right, it's a question of how big is that as an influence over the economy overall, and this is not the 1970s. And in fact, if you inflation adjust the price of oil today, it's the same level it's been for the last 20 years on average.
So before Iran, we had a rotation play in the marketplace, maybe out of some of the high growth, high multiple names, tech names, into some more value names, small and mid cap as well. How do you think about that part of the theme?
I think that probably continues, and you're seeing it today. So industrials are rallying, mid caps are rallying, small caps are rallying, value is rallying. The X mags are up smartly today over the S&P, even though the mags are higher because of NVIDIA. So I think that trade continues. The question is, what do you do to take advantage of some of the trader turmoil? And we think about that. Number one, if you've got losses you can harvest them. and either go back to your playbook pre-Iran or try and find shiny nickels. Where are the shiny nickels? Y'all were kind of giggling about this before, and I think you're right. NVIDIA is trading at less than the S&P 500. Now, does that mean I'm going to barrel into NVIDIA? No, but I'd probably take a harder look at it. And if you look at the tech sector overall, valuations have come down 30%, and they're where they were pre-COVID. There's been a lot of discounting there done, even though the earnings expectations have gone up. So I would encourage yours to keep to your knitting, stick with your playbook if you had the right playbook, hopefully you did. Take advantage of opportunities that this market presents, some of the shiny nickels, maybe that's tech, maybe not. So if you came in underweight, maybe that's an opportunity to re-rate. And then just be optimistic, because when we've seen geopolitical shocks like this in the past, when we've seen energy spikes like this in the past, 1 year later, markets were considerably higher.
All right, good stuff. David, thank you so much. David Waddell is CEO and Chief Investment Strategist at Waddell Associates, staying pretty optimistic on the markets here and also backing up what Paul was saying, that NVIDIA looks like an incredible bargain.